Thank you for joining us today. My name is Gabe Myers. I'm the CEO and founder of Peak Pro Financial. We're an advisor development company based out of Denver, Colorado, with a large focus on Index Universal Life. And today we have a special guest with us, Ben Roth from Minnesota Life, Securian Financial. Today, Ben is going to go through AG 49, how it's going to affect illustrations moving forward, and maybe some of the carriers and how some of that's going to work. Ben, thank you for joining us today.
Gabe, it's great to be with you. And thanks for inviting me. I'm glad to talk about AG 49. It's been quite the long and winding road.
It definitely has. Like, if you think about, we first started talking about this stuff, I think was back in like 2015 with the first actual guideline change. It's just interesting if you look at where we came from, being able to illustrate various different levels of spread between loans and index returns. And I think that, as we've seen, there's been a bit of an illustration war zone as it's gone on. I mean, we started with AG 49 and AG 49A, and now we've got this new subsection of A or B, but it's very interesting to see what carriers have done, whether it's multipliers or bonuses, and just the timing of mathematics in their illustrations.
Absolutely, it's been quite the journey. We at Securian entered the index life marketplace way back in 2006. And it wasn't until about 2010, after the Great Recession, that many carriers then jumped into the market, as you may recall, and became a bit of illustration wars starting in that 2011-12 timeframe. And more carriers were coming out with more innovative indexes and the best of the last three, and all kinds of strange, unique things. And that's when the regulators needed to step in and give us guidance as an industry with the original AG 49 in 2015, as you mentioned. And then that sprung and born multiplier accounts. We saw those then emerge in 2016, and it really, I think the multipliers caught the regulators and a lot of the industry by surprise, that it was basically a loophole or regulatory arbitrage, one might say, on the original AG 49. And that's what created AG 49A. Sometime in 2019, that started to come about. And now we sit here and we as an industry are calling AG 49B, but I think that's not the official language. It's going to be revised AG 49A or something to that effect. And that's a function of, when the multipliers were dealt with by AG 49A, that the regulators opened an opportunity for these alternative indexed accounts. And some carriers took advantage of that opportunity with the new regulation in AG 49A. And we've seen these alternative indexed accounts out illustrating the S&P 500 indexed accounts by a pretty healthy margin, in some cases 25 to 30% more illustrated retirement income or cash values than just your traditional S&P indexed account. And that's why we sit here today talking about AG 49B.
It's been a little wild. I think that, it's interesting to use the term innovation, and we talk about where carriers put together multipliers, and then even products where there was maybe a very inexpensive option cost. And, even though a client ends up paying for a portion of it with a fee, they were able to collect a bonus off of that isn't really guaranteed in an insurance product and pass that through in an illustrative methodology. That's not the innovation. The innovation is your base product strong? Is the cost of what your client's paying for, is that reasonable? And can you meet within 1 or 2 points of what you're trying to get to? 5 to 7% roughly inside of most of these plans is really what about they were designed for. And I know we a lot of times we're hitting bigger numbers, and we came out of a bull market the last 10, 12 years. That's just not going to happen, as far as I can tell, and the people I've spoken with. I don't know what your experience tells you and what your investment teams discuss.
Yeah, I mean, the 2010s was pretty good, despite a couple of blips there. It was a really good decade. The decade prior, the decade of the 2000s, as you recall, 2001, 2, 3, 8, 9, that was a pretty brutal decade. So wasn't surprised to see, this past decade of the 2010s, a bit of a reversion to the mean, if you might. And then now here we are in the 2020s. And now we've experienced both the high in 2021 and the low in 2020 with it was roughly 20% decline in the S&P 500 last year. And I think this is going to be a more normal decade in terms of you'll see 3 or 4 minuses on the S&P and probably 6 or 7 up years out of the 10. It's hard to predict, obviously, but that's kind of the normal decade is 2 or 3, maybe 4 S&P declines, and the rest are all up markets. That's what we're counting on. And it looks like we've got at least one of each out of the way.
I hope that's definitely the case. And we do a ton of review of product and analysis, and we dive into all of the products that are out there. Well, the reason we have such a good relationship with Securian and you is that the base product itself is relatively inexpensive as you look at IUL policies. And if we think about how we look at things, it's always, what's the cost, what's the hurdle rate, what's the driver. And I think that when you look at some of what a few of these carriers have done and why we're having this discussion we are today, is they think that this multiplier, the illustration or the bonus of what they're doing on their illustration is going to come through to fruition. And we've got situations where we've actually stripped those out. And instead of seeing a normal carrier, you see anywhere from maybe 2 to 3.5% over a 20-year period of time of the cost, we've seen upwards of 8 and 10%. Unfortunately, it's the clients that are the ones that are going to have to deal with this down the road. Ben, tell me a little bit about what is the change that's coming? What was the thought process behind it? Just maybe flow with that a little bit, if you would.
Sure. I think that, I can speak, having been involved in these conversations going back to 2015 with the regulators, I can speak a bit to the spirit of what they were intending. And there is a real clear risk reward to indexed accounts. You're getting some risk. You're willing to go to zero, and you're willing to go up to a cap in the more traditional indexed account, which is different than just a pure fixed account where it's just, it's a fixed rate that can change, but doesn't change very much from year to year. So there is a real risk reward premium to indexed accounts. And that was, the regulators very much liked the innovation of indexed accounts. And they wanted the industry to be able to illustrate that risk reward premium over a fixed account. Now, what has transpired, though, is if you think about, whether it's a variable annuity or a variable life insurance contract, we as an industry tend to illustrate those around like an 8% type of figure. And when you have indexed accounts and indexed products illustrating, at the same kind of 8% gross rate of return, which is what we've seen with both the multipliers a few years back and now these alternative indexed accounts, that's what really gets the regulators when they see that, there's a substantial risk reward premium being placed in the illustration over, prevailing fixed accounts. And that's really what both the AG 49A and now this AG 49B are looking to pull the industry back to a more appropriate risk return premium. And what I would offer to your listeners and your audience is that, roughly a 30% margin over a fixed account. So if you have a 5% fixed account, it's not inappropriate for an indexed account to be illustrating at a 6.5% type of rate. So 30% of that 5. It's when it becomes 60%, when it becomes 8, that's the kind of financial leverage that, really caught the regulators' eyes. So I think with this change, we'll see that risk reward premium pull back more towards like 30% over prevailing fixed account type of rate. And that's in line with what the spirit of the regulators are looking to see. And what my concern is, there is a vocal minority in our industry that are suggesting that if the industry doesn't get it right this time, if we abuse this privilege the regulators have extended to us, that the vocal minority may end up pushing indexed accounts even more conservative than they've already been regulated. And we could end up with index life illustrating like a fixed product someday down the road if there's ever an AG 49C. That's my greatest fear. And as a carrier representative, I'll be advocating with my peers that, hey, let's appreciate the privilege we have to continue to market and promote indexed accounts. There is a true, real consumer benefit. We want to retain that benefit, and let's not abuse the opportunity that's in front of us. Let's hope the regulators do not ever have to come back for an AG 49C, because if they do, I'm really concerned as to what happens then.
Well, it makes sense. They've been going down this track for a while. And I think in this industry, we certainly deal with two sides. We deal with the perception of what we think we need to have and the reality of what something is that we're promoting or selling. Fortunately, the two typically don't meet anywhere in what we do. I mean, I've seen these policies do fantastically well when structured the right way, but I've also seen them fall apart and, not done the right way. I just think there's a lot of education lacking around IUL. Do you see any foreseen changes, something with Securian? I don't know. Like we talked about innovation. I mean, again, I always think innovation starts at the base of your product and isn't just relying upon the index.
Yeah, that's very true. I mean, I think that you make a great point. Too many of our financial professionals, simply compare the end illustrative outcomes. They just look at which one's illustrating higher, and would certainly encourage them to maybe take a multidimensional view, maybe 2 or 3 looks. And in addition to just what is the illustrated outcome and comparing them, compare the charges, compare the policy charges, get a charges and expenses report for the products that are being considered, and understand, am I seeing higher illustrated benefits in one product because I'm getting substantially higher charges coming through the illustration as well? And that is one tactic that companies have taken of trying to create some form of financial leverage by charging consumer more so they can attempt to give them back more in perceived benefits. And so that's the slippery road, because we've seen what can happen. You have a few down years and those charges really start to eat up your illustration. And you want to be cognizant of looking at that. So look at the charges and then likewise, look at the benefits of the product, whether that's the actual cash benefits or the additional features. Make sure that you understand what additional features that come with the base policy and any agreements that you might be considering with the policy. Because surprisingly, there are some that are truly worth something and feature-wise, and there are some that are just smoke and mirrors. And it's important to understand what you're promoting to your client.
That's a really great point. A week ago, I was reviewing a new IUL with the carrier. And when you looked at it over 20 years, everything looked pretty good. When I backed it up, the costs were 10% more per year than the majority of carriers that we utilize. Whether it's a old world thinking process as actuaries built some of these products. I think one of the benefits of you being involved in the Eclipse and Securian being more of an accumulation focused company for so long, I think you guys take a good look at the benefits and the longevity that relies for those clients.
Being a mutually based organization, trying to deliver the greatest long-term policy owner value is what we think about every day. We're not conflicted with trying to take care of the shareholder in addition to a policyholder. It's all about the policyholder, figuring out what can we do to add value. We have gone back to old products, added new indexed accounts. We've offered up, long-term care riders to past clients that, bought 5 and 10 years ago. We've added bonuses to products that didn't have them when the products were initially launched. That's our form of quote unquote dividend, if you will, as a mutually based organization, trying to give back to the people who really were responsible for our company. And that's our policyholders. That is something that advisors need to consider, is what kind of company are they going to be there for me and for my clients down the road? Or is it all about the shareholder come 5, 10, 15 years from now? Those things aren't always thought of when a client's considering a purchase.
That's a great point. Ben, is there anything else to add on AG 49? I think we kind of covered most of it. Do you foresee anything as far as companies being able to do workarounds on? You don't have to go through what those are, but do you see some things like that?
Well, I think that we're, assuming the economic environment stays like it is become in the past year or so with increasing interest rates. I mean, the fact that the 10-year Treasury popped up 300 basis points is certainly going to benefit all policy owners, but it is mostly going to benefit newer policy owners. That presents an opportunity for the industry to provide, whether it's new buyers, higher fixed account rates or higher indexed account caps and participation. You'll see that emerge, and you've already seen some of that emerge in the industry where the product's illustrating. And so I think that will help offset a bit of this impact from AG 49B, if you will. The alternative indexed accounts may not illustrate as well, but the base S&P accounts, we're already seeing caps 10% and more. And that's something that we're taking a hard look at. You'll hear more from us in the form of innovation in the future. We're still really excited. We added the S&P Prism indexed account to a lot of our products, and that's been a really dynamic index. Of all the alternative indexed accounts, the S&P Prism indexed account performed the best last year in 2022. Eking out just a small positive return, but heck, I'd take the small positive return over the -20 of the S&P account any day. So encourage folks that are taking a look at Securian to take a look at that Prism account too. And so you'll see innovation in the industry and from Securian. So I'm excited about what the future holds, not as in fear as I was 18 months ago with 1% 10-year treasuries as to where we were ultimately going, because that was potentially a train wreck. And today I feel like we're out of the woods on one hand, but obviously inflation on the other is it's the other side of that coin. You need to have something with some upside potential for the future if you're banking on retirement, utilizing cash value life insurance as one part of your retirement plan.
Ben, thank you so much for spending the time with us today. It's always a pleasure, my friend, and this was very informative. I think that a lot of the advisors that are listening to this are going to get quite a bit out of it. This is a question that comes up a lot, so it's good to get perspective. All right, have a good one, buddy. Take care.
Thanks, you too.